If you retire at 55, it can feel like you need to cross this huge chasm until you're 67 and the state pension kicks in. And it seems like if there's a stock market crash in the meantime, you can lose a lot of your wealth, and this can cause a lot of uncertainty in the first few years of your retirement. And in this video, I'm going to look at how you can reduce that uncertainty and do some things to really prop up these key years. In the years up until 55, you're on pretty solid ground. You're on this rock here. You're earning money, saving into a pension. You can't yet access that pension, so you're not really so fussed about looking at its value every day because you just can't spend it. And if there was a stock market crash, then you just carry on working for another year or two to build back your wealth. So there's quite an easy solution to deal with things. We're talking here about a sequence of returns risk, which means that inevitably you'll have good returns or bad returns from the stock market. But if you get bad returns in the first few years, there's just a risk that your portfolio never recovers. And the danger is that if people have a certain amount of money they want to hit and then they'll retire, they could end up retiring at a stock market peak. And so they could end up setting themselves up for this very sequence of returns risk. So what you don't want to do is just launch yourself off this cliff like some kind of lemming when you're 55, because the danger is that you just go into oblivion of the abyss of the chasm. Instead, you want to put together a plan and have that plan sense checked by someone like myself, a qualified accountant with over 30 years experience, and then you can be like Dave Knievel here and jump the Grand Canyon and emerge safely on the other side. So from April 2025, the state pension will be worth nearly £12,000 a year, so £24,000 for a couple. So that's quite a good solid foundation to prop up your finances from the age of 67. So you could see a financial advisor, but they'll charge you 1% of your portfolio value every year to manage your investments. So if you've got £1 million pot, they're going to charge you £10,000 a year for 12 years. So that's £120,000. And what value are they really going to add for that huge amount of money? To me, it's just not that clear. So another solution could be to just have that £120,000 as a cash buffer instead. So rather than give it to someone else, you just put it in a high interest account, and then now you've got this safe asset that you can potentially draw upon if the stock market is in a bit of a downturn. One thing you might want to consider is taking tax-free cash in the first few years of your retirement. So if you wanted to take, say, £30,000 a year after tax, then what you could do is either take money from an ISA or the tax-free cash from a personal pension, and then that will put less stress on your assets, because rather than paying income tax and paying money to the government and having to take more money from your pension in the early years, you're deferring the tax, and hopefully during that time period you might get a favorable sequence of returns, or at least you've lived the first few years of your life how you wanted to, with less worry about the impact on your pension. A great solution would be to monetize some kind of passion that you have, maybe teaching something that you're really interested in, or just helping out in the local community. And the money that you earn can be really flexible. You can decide who you want to work with, when you want to work, and even where you want to base yourself. And if you can just earn a little bit of money, maybe up to the personal allowance, then that takes some pressure off of your investments without being tied to a 9-to-5 job. Whoever has the most choices available to them will ultimately be the winner. And if you've just got a huge pot of money but no imagination and no problem-solving mindset, then things might not work out well for you. But if you're willing to try new things and adapt to the changing world around you, then you can have a truly enjoyable retirement. When you're retired and you have no earned income, then potentially there is a need for greater diversification of your portfolio. Just having a global tracker might not be the optimal solution for you, and it's worthwhile researching some other asset classes and seeing whether you like the idea of the role they can play in a portfolio. So for example, gold can be seen as a safe asset and an inflation hedge, although some people think it's maybe quite expensive at the moment. Bonds can potentially go up in price if interest rates come down, although their recent performance has been pretty awful. Property shares or maybe infrastructure companies could provide a decent income stream. This income stream might rise with inflation. There might be some element of index linking, but these types of companies can have large debts behind them that can be a real pain. And then also there's trends such as working from home or online shopping that can really undermine the returns from commercial property. And then even within equities, you can look for ones that offer greater value in terms of maybe lower price to earnings ratio or a higher dividend yield, and you can just feel safer in having some more solid equities rather than keep looking for the next Tesla and the next Nvidia. And you can put together portfolios and then back test them on websites like curvo.eu, although it is true what they say and that past returns don't guarantee the same returns in the future. It's also important to have the right assets in the right accounts. So something like an ordinary taxable investment account, you're going to get capital gains tax, tax on interest, tax on dividends. So that's likely to be spent first, and you might want to put something like the UK government short-term gilt in there that won't have any capital gains tax and minimal interest income. That could be a good safe asset for you to have and potentially draw on in the early years of your retirement. And so it's not just about what you invest in, it's about how you structure your portfolio. If you want to learn more about putting together a robust plan for the first few years of your retirement and for your later life, well into your 90s, then check out my website. I'll put a link in the description, or otherwise you can watch this video.